Marcus teaches science at a Detroit high school. He's been paying rent on time for 9 years. He earns $72,000 a year. He has no debt. He's been saving for a down payment since 2015. When he finally walks into the bank, the loan officer types his name into a system. A request travels to a private company in Montana. 3 digits come back. Not because he missed a payment, not because he owes money he can't repay, but because the system measuring his creditworthiness was designed not to count the way he actually handles money. His landlord never reported a single rent payment to any credit bureau. 9 years, not one. Marcus didn't know that, and here's what he also didn't know. Every time that number was checked, he paid for it. Buried in closing cost he barely noticed was a fee to the company that just judged him. He funded the verdict. He just didn't know who wrote it. We investigate the hidden incentives behind a system shaping your everyday life. I am going to show you how a company founded by 2 engineers with $400 ended up holding the keys to American home ownership, and why the United States government helped them to keep those keys. Most people assume their bank decides whether they get mortgage. Your bank doesn't decide. Your bank follows a formula it didn't design, doesn't own, and cannot fully explain. A formula produced by a private company called Fair Isaac Corporation, a company most Americans have never heard of, even though its products control their access to housing, to credit, and in some states to employment. So how does a private company end up with this much power? 1956. 2 engineers. San Rafael, California. Combined investment $400. Bill Fair and Earl Isaac believed that mathematics could be fairer than man, that data could replace loan officers who had spent decades deciding credit based on race, gender, and neighborhood. They weren't wrong. For a generation of Americans shut out of lending by human bias, the credit score was a genuine liberation. For 30 years, the FICO score competed in an open market, one option among several. Then came 1995. That year, Fannie Mae and Freddie Mac, the government-sponsored enterprises that backed the majority of American mortgages, issued a directive. Lenders selling loans to these agencies were now required to use FICO scores. Required. One word, and it changed everything. That directive was signed when Marcus was in elementary school. By the time he walked into the bank 3 decades later, he had no idea system waiting to judge him had been locked into place before he was old enough to open a checking account. What happens when an entire industry is required to use one product? First, every bank builds its technology around it. Every investor comes to expect it. Every regulator assumes it. The infrastructure accumulates year after year, system after system, until the cost of switching isn't just expensive, it becomes essentially impossible. FICO understood exactly what this meant. For 30 years after their score launched, their pricing barely moved. Then in 2012, they began renegotiating contracts. Because the question had quietly changed. It was no longer, what is this product worth in a competitive market? It was, what can you charge customers who cannot legally leave? 2018, 50 cents per score. 2023, up to $2.75, a 400% increase for some lenders. November 2024, $4.95. Each charge paid by the bank passed to you in closing costs. Marcus paid twice for a score he couldn't see, couldn't question, and couldn't understand. 95% incremental operating margins, a stock that rose 48-fold in a decade. Senator Josh Hawley requesting a Department of Justice antitrust investigation. The FHFA director publicly calling FICO, I am quoting directly, a monopoly who has ripped off Americans for decades. Competition didn't disappear because FICO became better. It disappeared because leaving became more expensive than staying. The most powerful monopolies aren't protected by patents, they're protected by dependence. To be fair, FICO's defense deserves a hearing. CEO Will Lansing told CNBC, "We don't have monopoly. There are alternatives. We are there because we are good, not because we have some kind of special privileges." The founding argument has genuine merit. Before credit scores, discriminatory loan officers decided who got credit. The algorithm replaced bias with data. That mission was real. But here's what the defense doesn't address. The formula is a private trade secret. You cannot see it. You cannot challenge it. There is no neutral authority to appeal to if it gets you wrong, and it has never been publicly audited for the bias it was supposed to eliminate. When Marcus asked why his score was 661, the credit bureau said the model was proprietary. FICO's website offered tips. Nobody offered answers. We replaced biased human gatekeepers with an unaccountable private algorithm and asked government to mandate it. In 2025, for the first time in 30 years, Fannie Mae and Freddie Mac permitted lenders to use a competing score. FICO's stock fell 45% from its all-time high. The monopoly is cracking. But 30 years of embedded infrastructure technology, investor expectation, regulatory habit doesn't change overnight. Marcus eventually got his mortgage. He researched the system. He raised his score 14 points. He qualified. He still doesn't know why his score was 661. Nobody told him rent didn't count. Nobody explained that the scoring model was built around certain financial signals, and the ones most common among working class Americans weren't the primary ones. He paid for the judgment. He couldn't see the reasoning. There was no appeal. Here is what this story is actually about. FICO's founders in 1956 were solving a genuine injustice. Mathematics, they believed, could be fairer than man. For a time, they were right. But there is a principle operating beneath this entire story, one that goes far beyond credit score. Whenever private infrastructure becomes impossible to avoid, competition slowly stops working. The product no longer needs to improve. It just needs to be embedded deeply enough that leaving costs more than staying. The question isn't whether any single company is good or evil. The question is, what happens when an entire industry is built around something nobody can leave? And that something answers only to shareholders. 30 years after a government directive most Americans have never read, Marcus still funded the verdict. He just never got to see the evidence. This is the paradigm effect.